Welcome to the Chartered Financial Analyst Level 1 series of video. As usual, we will continue on the topic of corporate finance, and today we will have the video number 16. In this video, we will continue the discussion of the topic of measure of leverage, which we started in the video number 15. This will be the second video on the topic of leverage and how to measure it, and will be the last one. So let us start. Start this video by the conclusion we made in the previous video number 15, where we concluded that companies with higher fixed costs, either operating cost or financial cost, will have higher risk, because small variation or changes in the revenue will lead to huge changes in operating income and also in the net income. So the risk is very high. If we are selling 100,000 units and we made this much of profit, a small change in this unit sold, let us say 95,000, in one company it might have huge impact, turning a profit into a loss, while in other companies it will have minimal impact. That is the meaning of leverage. It levers the impact of any adverse effect. In such cases, and since the risk is very high, investor, that is the provider of fund to the company, will ask for more required rate of return, and then this will lead to lower net present value, because you are going to use higher discount factor embedded in the weighted average cost of capital, and then the valuation will be lower. So let us discuss the difference between financial risk and operating risk, also the business risk, both of them. The business risk relates to the fact that the company may not be able to sell quantities that it sold last year or years before, due to factors such as competitors or technology change or regulation. Some regulation might be enacted by the government that prohibit certain acts or certain commodities, or levying higher tax on certain commodities. The higher tax will deter customer from buying. Economic condition like high interest rate or any macro factor that might affect the number of units sold. This is called the business risk. The operating risk is definitely the impact it may have the fixed cost in the structure of the cost. If you have more fixed cost than operating cost, and than the variable operating cost, then the operating risk will be very high, which is the greater of fixed operating cost relative to variable. If it's higher, then the risk or the operating risk is higher. So basically, when we say operating risk, if you remember from the financial statement of the companies, there is income statement divided into revenue and direct cost, and then you get the operating profit. That is the one we mean by operating risk, the change in the operating profit. And also, after the operating profit, we deduct financial expenses like interest payment. We get, among other expenses, we get the net profit or the net income. So the financial risk will affect the net income, but not the operating income, while the operating risk affects the operating income. This distinction is very important. Now we need to measure the degree of operating leverage. As its name might show the reader, that the higher the degree of the leverage, the higher the risk. That means companies should strive to have lower degree of operating leverage. But how do we measure the degree of operating leverage? We measure it by the change of profit, the percentage change in the operating profit divided by the percentage change of unit sold. That is the operating leverage. We haven't yet discussed the financial leverage. The operating leverage is the revenue minus direct cost, you get the operating profit. That operating profit will change if we change the unit sold. So the percentage change in the operating profit relative to the percentage change in the unit sold will give the degree of operating leverage. Let us do this in numbers. For example, let us assume we have operating profit of $10 and sales of 100,000 unit. So if the operating 100,000 unit, we sold this time 90,000 unit. That means there is a decrease of 10,000 divided 100,000. That is 10% percentage change in units sold. And if we assume that the operating profit changed from $10 to $7, that is a decrease of $3 divided 10 will give 30%. So the percentage change in the operating profit or operating income divided the percentage change in units sold. That is 30% divided 10% will give the degree of operating leverage. Similar calculation will be made when we calculate the degree of financial leverage. That is the change in net income, because the financial leverage relates to interest payment, which comes after operating income. So we are talking about net income. Let us see this later. The sale risk, that means the quantities of there is a variation or variability of income caused by the standard deviation. Is the risk that price fluctuation. A small degree of price changes might cause variability of income. That means a smaller change in the price is lower might lead to higher income change. That is the standard deviation. How the income deviates from the mean? It goes up widely, then the sales risk is very high. If it doesn't fluctuate highly, just like the price, that means the standard deviation, it does not deviate very far. That means the standard deviation will be very low. Financial risk, as I just mentioned, it is relating to the company finances, how it finances its operation from equity or from debt. Debt has a fixed obligation. You have to pay interest, you have to pay monthly or semi-annually payment of principal. There is a fixed interest payment, regardless of units sold. If you sell 0 units, you have to pay. This is why we call it fixed obligation. Also, the term lease, long-term lease. Like, for example, if you are leasing a warehouse, and you didn't sell anything, you have to pay. So the leverage will be very high, because 0 sales means the whole fixed cost will be the loss, and the variable cost will be 0. So it is better to have more variables than fixed cost. As I just mentioned previously, the degree of financial leverage similar to the one on the degree of operating leverage, except that we use the net income and we use this percentage change of operating income, because we put the revenue first, we deduct the direct cost, we get the operating income. The degree of operating leverage, we divide the changes in these two items, units sold and operating income. Then after the operating income, we deduct the interest payment. So we get the net income. So the change in net income and change in operating income will give the degree. While the total leverage definitely is the sum of both, which is sensitive, the net income, to the change in the first line, the units sold, number of units sold, ultimately. I think this is very crystal clear, the change in net income and change in line number 1, number of units sold. Here the change in line number 3, revenue minus direct cost, operating income. This is financial leverage. But if we replace this with this number of units sold, that means we go to the first line and took also the last line in the income statement. So this will give the degree of the total leverage. The break-even point, I think all of us or most of us knows what it is. It means that the number of units sold, that the company doesn't make profit nor loss. That means we sell certain unit, number of units, we deduct the direct cost or the variable cost. What we get, we call it contribution. The contribution of sales towards covering the fixed cost. So let us assume that we have a fixed cost of 50,000 riyal. This 50,000, we need to produce enough unit and sell them, deduct the variable cost, get a margin figure. That figure should be exactly 50,000 so that our profit will be 0. The break-even point is the number of units produced and sold at which the company net income is 0. No gain, no loss. So it is simply, I will show you the formula now, but I want you to understand the formula before you see it. It is basically what we get from selling the units after deducting the variable cost. Let us think of it as we are building, for example, or constructing or working in a workshop that produces a sofa set. The sofa set has a direct cost of $5. We sell it for $11. So 11 minus the direct cost, 5, I'll get $6. That $6, if our fixed cost is $6, then that is the fix. That is the break-even point. So the equation is simple as this: fixed operating cost plus fixed financial cost. That means the total fixed cost. The numerator up is both fixed cost. Divide the contribution I told you. That is the price per unit minus variable cost per unit. Whatever you get, this is the number of units that you need to produce and sell so that you make no profit, no loss. Now, on the last point, we need to talk about some risk to creditors and owner. The points I'm going to mention here mainly center around the idea that it's a legal idea that creditors are protected first. In case of bankruptcy, the creditors get paid first, and what is left over will be paid to the owner of the company. So creditors are well protected while owners bear all the risk. So creditors are cheaper and owners are very expensive in the form of cost of equity. Lenders have prior claim on asset relative to shareholder, so they have greater security. As I just mentioned, in case of bankruptcy, they can claim the asset over which they have mortgage, or they took it as a security, or after selling all the assets, they get paid first. Equity provider claim whatever is left over after all expenses, including the debt, have been paid. So everyone has to get his money before equity holder can get any dollar. So they are called residual claimant. So unlike the fixed and non-commitment to lender, what is left over could be nothing or could be huge amount. So there is uncertainty around what is being left to the owner. In the next video, we will go to the topic number 5, which is working capital management. In this video, which is 17, the next video will cover liquidity and how to measure it and how to manage it, how to measure liquidity. And managing liquidity means not to have too many liquid assets, which does not generate enough return. We'll see that in detail. Managing cash position. You should not have huge cash sitting on your table or your bank account idle, because you could invest elsewhere and generate some income. And then we will cover investing short-term fund to cover liquidity shortage in the short term. So we will invest in a short-term funds. That means we get it quickly if we need it. I think with this we come to the end of the video. As usual, please do subscribe to the channel and hit the notification bell so that you get notified whenever I publish a new video.